Seoul office in '94, worked for a couple of years in Seoul, transferred to Beijing, worked there for a year, and then transferred again to New York, and worked there for 9 months before coming out to Silicon Valley to start my MBA degree. So this was back in '97. Upon graduation in '99, at the peak of the dot-com bubble, had the fortunate opportunity to enter the venture capital industry. There was a short period of time where VCs were trying to figure out dot-com business plans, and they were actually hiring freshly minted MBAs out of school. So I started my career at a firm called Vertex. Vertex is the venture capital arm of the Singapore headquartered sovereign wealth fund Temasek. And we were a very active fund investor in all the tier one funds. And we would also do direct investments, getting access to deal flow through the fund investment relationships in later stage rounds. So while I was doing that, I was one of the very few Korean nationals in the Silicon Valley VC industry at the time. And I was recruited by Samsung to start Samsung Ventures in Silicon Valley back in 2003. I ran that for 4 years, left in '07 to start my own firm called TransLink Capital, which I collaborated with some other colleagues that had similar backgrounds, all US venture capital heads for Asian technology companies. So I worked with Taiwanese, Japanese, Chinese partners, and collectively we would provide access for the corporations out of East Asia to get access to startups in the US startup ecosystem. I left TransLink at the end of last year. I'm launching a new fund. And in the meantime, I'm advising a number of other funds. One of them is Deutsche Telekom Capital Partners, affiliated with Deutsche Telekom Group, the largest telco in Europe, investing in Europe, North America, Israel, as well as recently we launched a Seoul office. So we are actively looking to invest in typically B2B enterprise-focused startups. I think we're very close to closing our first opportunity there. In addition to that, I'm also an advisor to a Korean headquartered VC called TBT Partners, who you may know. Jong-wook Lim is involved, and another fund I'm advising is Primer Saza Partners. So been pretty busy, pretty active, and I'm looking forward to discussion today.
Great. With your Korea fund for Deutsche Telekom, what is your check size? Is it? Did you mention it is Deutsche Telekom where you're investing in Korea as well?
Yeah, so Deutsche Telekom Capital Partners is effectively the venture capital private equity arm of Deutsche Telekom Group. It is a financially oriented firm with over 2 billion in assets under management. Typically, we are a growth stage investor, so typically Series B and beyond. So we look for financial metrics. Ideally, we focus on B2B SaaS opportunities, which I understand are rare in Korea. But check size in general is anywhere from 5 to 25. In Korea, our first deal is going to be sub 5, and we expect anywhere from 3 to 5 or so is going to be our sweet spot in Korea.
Okay, great. Good to know. Okay, well, thanks for the introduction. I think we'll just dive straight into the questions now. And for people on the call, we'll hopefully have some time at the end for some questions from you. So feel free to start thinking about questions you might have for Jay. And I think the best thing is to just drop your questions into the group chat at any point, and then we'll address those as we get to the end of the conversation. So regarding raising international funds as a Korean startup or raising from international VCs, is there a sweet spot in terms of company development stage, would you say? Bearing in mind that the companies in this program, most of them I would say are early stage, but some, let's say around a third of them, have raised some capital and are looking probably at their next round of somewhere between 3 to 5, I would say. So yeah, is there a sweet spot, generally speaking, for international fundraising?
Right. I think there is, and I don't think it'll come as any surprise. I think typically pre-revenue early stage opportunities, it's just so much more difficult for a internationally based investor to come in and basically bet on the team,
Hmm.
right? I mean, that's just a really high bar. And if you also think about it, those kind of opportunities are prevalent very close to home, right? Now, as many of you know, a lot of the venture capital firms in Silicon Valley now have evolved to have multiple funds and multiple teams. So even for the early stage VCs like Sequoia Capital, Axel, Kleiner, you name it, they have a typical traditional early stage fund that invests in typically Series A, sometimes seed opportunities. But all of the big boys, to my knowledge, maybe with the exception of Benchmark, have a growth fund. And these growth funds look for opportunities anywhere and everywhere. Doesn't matter the sector, doesn't matter the geography. And so I think it's well documented that, early on in the growth stage of Coupang, Sequoia was an investor there. Market Curly is another Sequoia investment. And there has been recently with Toss Bond, which is the growth arm spin out of Kleiner Perkins, also invested in Korea. So if you're at a growth stage, and a lot of US-based venture capital firms define growth stage at a, close to or above a $10 million ARR or annual recurring revenue run rate, then you will be interesting for these investors. Okay, so again, that is a really high bar. Obviously, $10 million IRR. In some cases in Korea, it's companies go public on that in the Korean Stock Exchange. So it is very much growth stage oriented. Now, having said that, there is a trend for these international investors to try to identify higher growth opportunities, ideally a little bit earlier, so that you don't have to pay the exorbitant valuations. But I would say, unless you are growing at anywhere from a minimum of 5 up to $10 million ARR, I think it's just really difficult to convince international investors to come to Korea to invest in you. Now, the exception to that is, and we know examples, I think, we're going to talk more about them, Nathan, later on, but there are Korean founders that started their companies in Korea or moved their companies very early in their growth to the US. And these companies, because they are effectively now US companies, can actually raise capital from, even at a seed stage, Series A stage, from local investors if they have a good story to tell. And obviously the founders have credibility. So to me, it has to be one or the other. Either you've dominated Korea, you're at a growth stage, then they will come to you. If you're early stage, then you kind of have to come to them. And it's very rare that an early stage company based in Korea can attract capital from overseas.
Okay, that I think that lays it out very, very clearly. It's good to know. And for some, there are a few companies in this group as well that are considering making a move overseas. In fact, Perseus is one of those that you're aware
Yeah,
of.
I
Yeah,
think I'm familiar with this, with
yeah,
them, thanks to you.
yeah, yeah. Okay, very good. And again, if companies in the call have any follow-up questions to that particular topic, feel free to drop them in the chat at any point. So I think you've partly answered the next question with your first answer, in terms of the metrics that startups should focus on. You've mentioned quite specifically that investors would be looking for $5 to $10 million in annual revenue. Are there other metrics that startups should really focus on? And I think that with metrics, this is something you should plan for ahead of time as well. So are there metrics that Korean startups perhaps fail to put enough emphasis on, or things that they should be aware of if they're looking to raise internationally in the future?
Personally, I think the Korean startup ecosystem, as well as the investor ecosystem, has evolved a lot. So I don't see massive differences In fact, I see a lot of the same KPIs in Korean startups that I see here.
Hmm.
Um, I think what I can share with you from a growth investor perspective, and this was very interesting for me because, for most of my career, I was focused on Series A early stage, but now having worked with Deutsche Telekom Capital Partners for almost a year, I've learned about what growth stage investors look at in far more detail than I actually had imagined prior to that.
Okay.
And just to share kind of the high level, I think most of the entrepreneurs here on the line will agree. At the end of the day, if you think about what values a company, even in the public markets, it's typically narrowed down. There's a lot of factors and ratios and KPIs, but at the end of the day, it's really two factors. One is cash generation, or what you call cash engine, and the other one is growth engine, right? So you look at the profitability, how much free cash flow is generated from the business, okay? And the other element that you see is how fast is that growing, okay? So really, the company that is growing at the same rate, but is a higher margin business that generates more free cash flow is naturally going to be valued higher. Even at the same profitability, a company that is growing faster is going to be valued higher. So at the end of the day, those are the two things that should be driving your business. So as long as you keep in mind, ideally you want to pursue both. And that's why, SaaS software-based companies are generating the high multiples in valuation, is because they have naturally high margins and ideally high growth. And that's why you have the combination and the double whammy that provides, the dramatic opportunities. Other examples are e-commerce. E-commerce typically are low in margins, but super high growth. And thus you can have that, but the multiples are far less. So those two elements, and if you break down those elements into what goes in, then it should come up with your KPI regardless of what sort of business you're in. It doesn't matter if you're a B2B SaaS company or an online gaming company, semiconductor manufacturing company. At the end of the day, those two are the metrics that drive valuation. For public, naturally, that trickles down to private round valuations as well.
Mm-hmm. Okay. And just a small add-on to that question as well. So do metrics from Korea count? And I guess what I'm getting at is, would a Silicon Valley VC or any international investor look at Korean metrics and kind of presume that those metrics could translate internationally as well?
Yes. So again, every single international VC funded Korean company, right? They dominate in Korea, right? Maybe with the exception of the gaming companies that have been funded, where the revenue sources are global. You take Coupang, Market Carly, Toss, or any of the unicorn companies out there. All, if not, or Pedareminjok, all, if not, the vast majority of their revenue is domestic revenue in Korea. So, do metrics in Korea matter? Absolutely, they do. They're real money. They're real metrics. Now, does that translate to success overseas? Not necessarily, as we know. We know the bar is really high. And in many ways, the companies that have been successful domestically are optimized for Korea. So it's not necessarily easy for them to expand internationally, and especially where the domestic competition in other international markets may already exist. So it's not a guarantee, but the point I'm trying to make is international investors, if you dominate in Korea, that's actually enough. Korea is a big market. It's a big enough market. You can have billion-dollar unicorns, as you know, come out of the companies. And so it's not a requirement to be able to demonstrate that you can actually expand internationally.
Yeah. Okay. Right. Well, we'll move straight on then. So the next question is about actual case studies of Korean startups that have been successful in their international fundraising, but also more generally market expansion. And again, obviously, there are companies like some of the ones you've mentioned, TOS, Coupang, Bemin, that have raised lots of international funding. But I'm wondering about cases of companies that have raised funding and also taken their companies global from Korea. Are you able to explain or to give us one or two examples and also suggest why they might have been successful?
Yeah, there's unfortunately not a lot of examples of
Yeah.
successful companies that have expanded beyond Korea. The companies that I've heard of do that very successfully. You know, for example, a company called Azar that I've heard has done very well in kind of social networking and whatnot, and has a very global international base. There's several gaming companies that have done that as well. But in general, it's been very hard. Typically, and this is very similar to what I mentioned earlier, uh, the two cases that actually can get international funding are actually the two paths for success, in my opinion. So the one case is you dominate in Korea and then you raise enough capital, build enough of a cash base that funds your international expansion. And obviously investors can help you fund that as well. So, you know, whether it's Pedal Minjok expanding into Vietnam or again, trying again in Japan, you know, those are opportunities that they can actually go after, right? So that's one example. The other examples are cases where, again, the Korean entrepreneur came out to the US and started a company in the US. And they may leverage resources in Korea, R&D, you know, sales and marketing, brand building, fundraising, etc. A great case of that is Noom, which I think everybody is familiar with. They are now considered, you know, an almost unicorn company. Most recent round last year, backed by Sequoia's growth fund. You know, growing rapidly. It's rare that it goes by a day that I don't see a Noom ad, either on TV or online. They're growing gangbusters, and they've proven the growth metric that despite the marketing spend, which is exorbitant, they can actually justify that because the LTV actually justifies spending that customer acquisition cost. And so that's a great example of a case where they've been very successful. I'm sure the Koreans in the audience, and I always use this analogy, so this may be boring for folks that have heard me speak about this, but in order to succeed in the major leagues, it's either one or two paths. It's either like Hyunjin Ryu, you dominate in Korea, you're an all-star pitcher, and you dominate, you come out to the major leagues, you're a starter from day one with the Dodgers, right? And you're established. If not, then you have to do the other route, which is Shin-Soo Chu's route, where you come out to the US early. Right after graduating high school, he joined the single A minor leagues, went from single A, double A, triple A, and eventually went to the major leagues. And a couple of years ago became an all-star. So there's different paths you can get there. What, again, you cannot do is, if you're not even a starter in the Korean league, to expect to come out to the majors and succeed is just unrealistic, right? So I think it's really important to pick a path, and that path has to be leveraging your advantage. So, you know, a good case study is Senberg. So Dongshin, John, very impressive guy. He's one of the few guys that he's a completely native Korean guy, right? But he was educated early on in the US. His English is flawless. He was a professional gamer, became a successful entrepreneur in Korea with a gaming company. And then he moved out to the US, started a company in the US. And Senberg originally started from a different company. He was actually doing more of a family social network early on. And he converted that company because that company wasn't necessarily getting traction. And they were trying to solve for their own purposes, you know, the messaging aspect, trying to build that on their own. And eventually that led them to become the leading messaging API company. So they actually moved back to Korea, flipped back to the US. They've gone back and forth a couple of times. Now they're considered one of the leaders in the messaging API business globally. They're one of, again, the fastest growing companies, backed by very reputable firms here in the US. And so if you're capable of swimming both lanes, if you're a hybrid, that is completely native over there, native over here, have the ability to go back and forth or start in whichever market that you choose. But if you're not, then I think it's important to understand that there's multiple paths to get to the major leagues, and you should be focused on the path that best suits your skill set and experience.
Yeah. John and Senbert are an interesting case. John, obviously, as you mentioned, had a previous successful exit, multi-million-dollar exit. So he had that, founder experience as well. And interesting, the next question is actually about the value of attending an international accelerator. And actually, in the case of John, he attended both Techstars in London, with Smile Family, which was the company you mentioned that he founded earlier. And then with Sendbird, he went to YC. Do you think that these international accelerators should be a part of the game plan for Korean startups that do want to make this international jump fairly early on? Is that a good route?
Absolutely. I mean, again, any of the international accelerators, and in particular Y Combinator, has a reputation of having high standards. So in a way, if you're an investor that is meeting with a YC company, there is that mark of approval that they have gone through the YC relatively rigorous screening process that YC has. They have learned through YC about growth hacking and acceleration. They have a YC network. So by definition, they will have a competitive advantage versus a company that has not gone through a YC process. Mm-hmm. So 100%, if you can actually go through a YC opportunity, I would strongly encourage that. It's going to be hard. It's a relatively high bar. But it's not only YC. There's 500 startups and a bunch of other accelerators that, again, will give you the stamp of approval, especially because if you are a startup that is fresh off the boat coming out of Korea, it's very difficult for a US-based investor to relate, right? So, I was born and raised in Korea, so I know if an entrepreneur used to work at, Samsung or went to, I don't know, Seoul National or Keist, immediately those ring a bell for me. And yes, Samsung, I think everybody knows now. But if it's not as a well-known multinational, then you just don't have the credibility or the familiarity that the international investor would feel more comfortable with. And remember, you're competing against guys that have graduated Stanford or Berkeley, that have worked at Facebook or Google, right, for the same funding opportunities. So if you can go through those, I would say accelerators or training academies, whatever, and get their stamp of approval, that's clearly an advantage and gives you an opportunity to increases the chances of raising capital here.
Yeah. And for companies in our program as well, we do have connections with a lot of accelerators internationally. We've made some of those connections already. So if that is a route that you're interested in pursuing, do feel free to get in touch with me or Peter afterwards as well. Right. So the next question, as we both know, there's a lot of money pouring into entrepreneurship in Korea from the Korean government. A lot of these programs tend to help very early stage companies raise internationally. It's an ongoing discussion about really what the chances of success with this type of program are. And my personal feeling is that often these types of programs attract the really early stage companies, and my feeling is that sometimes there's a misfit really between the goals of the program and the stage that the companies are in. And I think that what you've said earlier in this conversation kind of demonstrates that would be the case. So with that in mind, if it's just unrealistic for companies to raise money through a vehicle or through a program like this, what are some of the other values that they could take from a program like this? And I believe that these programs are valuable, even if the core goal of fundraising is maybe unrealistic.
Right. So the good news is, I think the Korean government, and again, we have to be appreciative of how much support the Korean government is providing to the Korean startup ecosystem. It's
Yeah,
unparalleled.
yeah,
Okay. So I work in the US. At TransLink, I work with partners that cover Japan, Korea, Taiwan, China. Nobody comes even close. I mean, the only, I think, international other country that I can think of that is as supportive from the government level is Israel. But the amount of funding that the Korean government pumps in into the ecosystem, nobody comes even close. So we should all be very thankful for that. Now, clearly there has been, I would say, areas of improvement to make things more efficient. And Nathan, you and I both know over the years, all the attempts that have tried to bring earlier stage Korean companies to get international funding, I think we're batting 0 for several hundred. For several hundred companies that have come up, I can barely think of a single startup. I mean, there's probably a handful, out of several hundred companies that have actually received funding. So it's a very, 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 very inefficient process. Now, the good news is the Korean government has actually changed their stance. Now, as you may know, the goal of the Korean government for startup funding is actually to generate more unicorns, right? And they've realized the number of unicorns is actually a good metric. And they've also realized that unicorn makers are not necessarily the investors in Korea. They're investors that are overseas. So they've started a program which I'm an active subscriber to. So for example, KVIC, which is the Korean fund to fund backed by the government, has started a K Unicorn program where they are actually taking growth stage Korean startups in IT, biotech, and other sectors, and they're giving them a forum to international investors. So they have a online platform, and they actually do a pretty good job recording business plan pitches, even interviews from customers as well as existing investors. And so for me, it's actually a very efficient way without going through the effort to try to meet a Korean company. I can, in the comfort of my living room, be able to, in about 15 minutes, assess if an opportunity is interesting. And if I am interested, they'll connect me right away. And actually, we are at Deutsche Telekom Capital Partners evaluating a company that was introduced through that K Unicorn program as our potential next investment. So those opportunities are there. And I think the Korean government is also learning and evolving, which is great news for everybody.
Yeah. And that's obviously good to hear. And I've been involved in Korean government programs now for many years, and I would completely agree that the quality of the programs is improving pretty much across the board. Just to kind of touch on part of my question again. So, assuming many of the companies in this program are not quite at the future unicorn stage, what kind of practical values could these companies derive from a program like this? Because I think we've basically made clear that fundraising internationally for an early stage company is going to be extremely challenging, almost to the point where it's near impossible. So what practical values can companies derive from a program like the one that we're operating?
I mean, Nathan, that's, I think, a question that I should be asking you. But the way that I think about it is straightforward. Look, raising capital internationally is almost like, to me, a graduate school program.
Right.
Okay, you don't jump into a graduate school program without going through high school, undergrad, etc. Right? And I think programs like yourselves and other programs, provide entrepreneurs that maybe have not done it before with the basics. You need to learn your math, science, English before you can take graduate school courses. right? And so I think there's so much, more that you guys can offer in terms of how to think about a business opportunity, how to put together a business plan, how to think about recruiting a team, how to manage the team, how do you think about opportunities, how do you do market research, how do you build a product, etc. And there's so many basic elements that you need to create a startup. And I haven't seen it myself, but I know that there's a popular Netflix series called Startup now that's getting popular in Korea.
Mm-hmm.
And I don't know if that actually covers that process. I'm guessing it's going to be a little bit of a cheesy romantic thing. Sorry, I could be wrong, but I just feel that you need to learn those basic elements. And quite frankly, entrepreneurs that, at least in the US, succeed more are people that are not necessarily fresh out of school. And yes, there's the exception every once in a generation, like Bill Gates or Mark Zuckerberg. But in general, most of the successful entrepreneurs, at least in the US, age average is anywhere from 39 to 40 years old, has at least 10 years of business experience. So they actually know what they're doing, and they have expertise and a network in their sector that they're focused on before they start a company, right? So for those companies, for those experienced entrepreneurs, they only need to understand how the startup game is played, how to raise capital, how to do, participate in government-sponsored opportunities to get advantage of all of those. But if you're coming straight out of school, have never run a business, never worked at a company, then you need to put your training wheels on and start from the basics, right? So I don't know which, do you focus on kind of a junior high school level or high school level or undergrad level? But I think all of those are important because there's different types of entrepreneurs with different backgrounds.
Yeah, yeah. And we have tried, certainly through this program as well, to provide some of the basics. One of the obvious ones is helping companies to put together a pitch deck, basically.
Right.
With a globally relevant pitch deck, I guess, is more important. Yeah.
Yeah, for sure.
Yeah.
And it's actually not that different. The decks that I've seen in Korea, the good ones, are the good ones that I see here, and the bad ones are almost very similar as well. So it doesn't really matter. And again, Korea has evolved so much in the past 20 years. The quality level is almost non-existent. The best companies in Korea are going to be the best companies that get funded here, and vice versa.
Yeah. So next is a fairly quick question, I think. How long does it typically take to raise money from an international investor? So, is it a matter of weeks or months? What and how should companies prepare for the process? And the reasoning for this question is that I feel that many companies that we work with underestimate how much preparation they need to do in terms of also gearing up for the due diligence process, and also how long it will take and how much of the CEO's time it will take. So any advice?
Yeah, it's a great question. So first of all, again, let's realize that the fundraising, if you're not ready as a business, let's say, based upon the metrics that we discussed. So, I'm Deutsche Telekom Capital Partners, and I meet a Korean company. It doesn't matter how much fundraising preparation you do. If your business is not within that sweet spot that we're looking for, we're wasting time, right? So fundamentally, your business needs to be at the stage where that international investor would be interested. And as I said earlier, typically, not all the time, but typically, most international investors that invest anywhere overseas, and this is not just Korea, it's an international investor that is investing in a foreign country. 99% of those times are going to be in growth stage.
Right.
Okay. As we discussed, because again, these growth funds are looking for opportunities globally, and they have metrics, as we discussed, typically a $10 million revenue run rate. So the point I'm trying to make is, if your business is not there, you're wasting time trying to raise money from international investors. Okay, if you're a Korea-based company and you're not at that revenue run rate, you're wasting your time. Again, if you are a Korean entrepreneur that is based in the US, then you're an early stage startup. You're not a Korean company. So you can raise seed capital at a pre-revenue stage. It doesn't matter. Now, let's assume that you have got to that revenue run rate. So you qualify within the boundaries of interest. Okay. Now, how much time does it take to get to the next step? Now, it's all relative. It takes time to raise capital from Korean investors, right? And I had a fund with TransLink that invested in Korea, TransLink, which you may know, and the due diligence requirements are not that different. They're looking for the same elements. You need to have, your financials prepared, both historic as well as future forecasts for the next 3 years. Right? And those have to be driven based upon assumptions that make sense and reasonable. Because if you can project growth over time, the one thing that I've seen more in Korean startups than US startups is this amazing hockey stick growth. So we're in, year 2020, and, the company last year was $500,000 revenue. This year they've grown to $1 million revenue. Next year they're expecting 10 million. And the following year it's 50, and then it's going to be 100. That is just unrealistic. And those growth metrics that I see typically show the naivety or the lack of experience of that entrepreneur, because clearly they've never been in that situation and they don't understand. It's very rare. It's not impossible. But it is almost impossible to grow 10x in a single year. I don't care what it is. And then if you look at the underlying metrics that drive that, there's going to be dramatic changes in those assumptions, right? So you can't just, 10x growth your customer base overnight, or just increase the revenue you generate per customer 5 to 10x overnight either. So I think having a strong financial person on the team is actually something that I'd highly recommend at a growth stage. Somebody that has some background, investment banking, consulting, accounting, whatnot, will help you raise the capital, because they will know, okay, in terms of modeling and financial numbers, to be able to provide the initial set of metrics. And then most investors may ask for more. Like Deutsche Telekom Capital Partners, we, for example, are extremely metric driven, right? We have something called a fit test, where we have 8 different criteria based upon numbers alone to see if it makes sense to even do any due diligence, right? But if you don't have somebody strong and familiar on the financial side on your team, then it's going to be really difficult to satisfy the due diligence requirements for those international firms. Now, the good news is, if you are an experienced financial CFA, consultant, investment banker out of Korea, they are, they can do that job plenty fine. It's not going to be a problem. But if you don't have that somebody on your team, then before you go fundraising, I'd highly recommend hiring that person, even as a consultant, even part-time, before engaging, because that could dramatically improve the efficiency of the due diligence process.
I'm glad that you've provided that level of detail in your answer. Metrics are something that we try to spend a lot of time on with companies when we're helping them prepare their investor pitch, and I do feel that it's an area where a lot of companies we work with, perhaps they simply don't have the metrics, which means that maybe their company is not ready yet, or they haven't, for whatever reason, been able to highlight the metrics that really count. So I think for everyone on this call, it's the metrics that Jay's talking about are really, really important. Would you be comfortable sharing the 8 criteria or metrics? Is that proprietary?
No, I don't think it's proprietary. Look, I think what I can share is pretty straightforward. What I can share is, again, the high level philosophy I've already mentioned. It's driven by two engines. It's
Right.
the cash generation and the growth engine, right? And so if you think about from that angle, there's going to be specific metrics that come down from that. And so I can give you a snapshot verbally of what we typically look for on these fit test
Okay.
aspects, and none of them are going to be proprietary or breakthrough and whatnot. A
Yeah.
lot of them will be somewhat focused on SaaS
Yep.
revenue metrics, which may not apply to all different types of businesses. But I'm more than happy to share with you kind of what are some of the things that a typical growth investor looks at in general. And it's not going to be specific to Deutsche Telekom Capital Partners, but it's typically applied to any single growth investor that you would come across. So one of the obvious ones. Let's start with growth. Okay, so from a growth perspective, some of the obvious ones are really it shouldn't be that difficult to imagine,
Yeah.
but the growth in terms of either ARR or annual recurring revenue or revenue, right? Because ARR numbers and revenue numbers from a GAAP perspective are typically a little bit different. So, growth, they're going to be looking at that, for example, pretty straightforward element. What they will also be looking for is, what is on the other side in terms of cash generation, what are your gross margins for your business? Okay. So that's another angle that you would look at. And, when you combine those two different aspects and you get a sense of how big this is growing, then it becomes pretty obvious kind of where the opportunities are going to be. Okay, so let me just give you some, and again, keep in mind, these are typically SaaS metrics. So you have growth, cash generation, and also what's important is efficiency. So let's say on the growth side, growth efficiency actually matters. So there is something called a magic number. I don't know how familiar that concept is used in Korea, but basically what a magic number is if you spend $1 in marketing, okay, how much additional net IRR or net revenue do you generate from that $1? So typically that ratio ideally could be if you spend $1 in marketing and then you can generate at least $1 in terms of additional revenue or new net revenue, new net ARR, then that's considered a positive. So you want that magic number ideally to be at least more than 1. Mm-hmm. Now, sometimes you can actually have it less than 1 because you're so focused on growth, but typically you want to see those kind of elements. There's also something called the rule of 40%. Is that something, Nathan, that is widely used in Korea at all?
I've honestly not heard of it.
Okay, so let me explain. So
yeah.
The rule of thumb, again, in SaaS metrics is the combination or the addition of growth rate on an annualized basis and your margin, you want to be above 40%. Mm-hmm. And it's very arbitrary. It's kind of weird why that's the case. But if you think about it, if you are a 70% gross margin business, it means that you can actually grow. I'm sorry, let me back up a little bit. So the 40% rule applies to the combination of profitability and growth. Okay. Now, typically we know that a fast-growing company could be growing at 100% year over year, right? And as a startup, you want to grow, twice as much, which means that it's okay for you to lose money. And I'm sorry, I should clarify. It's not gross revenue. It's actually net profitability. Could be up to, if you're growing 100%, you could be minus 60 and still satisfy the rule of 40%. Mm-hmm. Because in a typical early stage fast growth stage, you are investing in growth. So you don't mind losing money net, right? This is not gross revenue, this is net margin, then it's okay to do that. And there's plenty of public companies that have demonstrated that. Now, as a company grows over time, the rule of 40 still applies. So the growth rate will go down, right? But your net margin will increase. And by the time you go public, where typically 20, 30% growth rates are completely acceptable on a $10 million revenue run rate, right? Then you're expected to start generating net profit,
Yeah.
10%. So if you're growing 30% and your net margin is 10%, you're still, you fit the rule of 40 number. So cash engine, growth engine, and efficiency all matter. Because what you don't want to do is, you're growing really fast, but if you're burning a ton of money to grow, that's not necessarily a great thing, right? And if you're not profitable, or at least you have some metric that can get you profitable in the future, then that's not exciting to an investor as well. So I know I haven't disclosed the 8 rules of thumb one by one, because it's meaningless to talk about specifics, because each growth investor will talk about different things. But just remember, cash generation, cash engine, growth engine, and efficiency are the 3 key factors that growth investors are going to look for.
Okay, no, that's really helpful, and I'll look into this rule of 40 afterwards, and perhaps provide an explanation based on those 3 metrics of growth, revenue, and efficiency. I like that. So we'll share that. We'll put some time into researching that and send some information.
Yeah, remember, again, this is typically more SaaS metrics.
Yeah.
So if you were a recurring revenue business, it doesn't apply across the board, but it's become pretty much standard. So if you do a Google search for, rule of 40 or magic number, it'll be there.
Okay, great. So moving on to COVID. Yeah, so obviously COVID has changed things. And over here in Korea, we've heard different things over the course of this year, ranging from LPs have really told their investors, their VCs, to hold back, meaning that there's less money available. And on the flip side, that investors are finding it just a lot more difficult to find companies to invest in, and therefore, there's potentially more or easier money to access, because there's money out there that investors can't use, as it were. So I guess that's kind of one thing. What is the situation in terms of capital available for investment? And secondly, how has COVID impacted investors' ability to invest in terms of everything being online? We can maybe start with that and just see how this conversation goes. So I guess the first thing is, how much capital is out there?
Okay, so again, this is just a very subjective one data point, and I'm just sharing with you from my perspective, which is relatively limited, based in Silicon Valley. But when the initial COVID crisis hit, and I think this applies anywhere, if there is a shock to the system, investors typically basically step back and are inward looking instead of external looking, meaning that we're too busy to make sure that our existing portfolio companies are actually going to survive a disruption or a crisis before spending the time to add another portfolio company. Mm-hmm. Okay.
Right.
So typically what happens in these crises is every investor will go through a process called a triage. And the triage, folks are maybe not familiar with, it comes from a concept where if you're a medical station in a war zone, right, with limited medical resources, staff, nurses, medical supplies, then you have to basically categorize every single wounded soldier that comes into the tent in 3 categories. One is you're going to actually work on them because they have a chance to survive, right? The others, you don't have to even do any work. They're going to be fine. You send them off. Or the ones that are actually going to die regardless of how much work you put in, you don't put any work into that, because every single hour or every single resource you put in there is going to be an opportunity cost for somebody that you can actually save, right? So you basically categorize into those three chunks portfolio companies. Companies that are doing fine, that don't need your help, you don't have to worry about. They don't even have to come into the tent. But then you have to make the very, very tough determination of which ones you let die and which ones you actually try to salvage, right? Again, because you have limited capital and limited resources and time to help these companies. So I believe that, in the early days, first couple of months of COVID, every single investor went through that process within their portfolio. And if they didn't, they're not doing their jobs right. Once they went through that, then they know which ones to salvage, right? And which ones to let nature run its course. Then you're trying to support those companies. The good news is the stock market, as we know, had a big dip in late February, early March. And within a month, it rebounded dramatically, right? To everybody's surprise, nobody was expecting that kind of a dramatic rebound. And as you know, this year has been the year of the mega tech IPOs. So all of the companies that were in the pipeline, except for a few, but you never know, even Airbnb could come out before the end of the year. A lot of companies went out public, and many of them have done really well in the public markets, okay? So that gave investors liquidity. Right. In fact, it gave them unexpected liquidity, right? Which gave them the confidence, not only the capital, but the confidence, oh, maybe this is not a disaster after all. Maybe we actually still can invest in new opportunities. And what I would say now is there are plenty of new funding events that are happening right now. I wouldn't say it's back to pre-COVID levels, but it's very, very busy. And I'm sure you're seeing the same thing in Korea, if not more so, because it's more business as usual. But I think a lot of investors are extremely busy looking at new opportunities. A lot of companies are getting funded. Again, I don't know if it's quite at the level of pre-COVID. I think it's getting close. My gut feeling tells me 70, 80%. So new companies are getting funded. Now, what has changed with COVID, though, is because, and even more so here in the US, because meeting people in person, you can do that in Korea. I've been in Korea, during COVID, and it's almost like business as usual. I've had business meetings, lunches, dinners, drinks, everything. In the US, that's much harder to do. So typically, unless you have had an existing relationship, meaning that you've met the entrepreneur in the past, you've heard their pitch, you've met them, then it's a lot easier to focus your efforts on the ones that you're not meeting for the first time. Okay? So because more times than not, it's a relationship building process. It's very rare that whether it's in Korea or Silicon Valley, you have one meeting and boom. It only happens in movies and dramas that, I like your story a lot, here's a check. That does not happen in reality, okay? So typically you have those relationships. Now, there are opportunities that you've met online, you like them, you continue the process, you've done your due diligence, and you really like them. There are VCs that are comfortable just writing the check. And this year, from my personal perspective, I've done 7 or 8 angel investments. I've not had to meet any of them in person. But remember, those are angel investment checks. They're small checks, anywhere from 10K to 100K, typically 25 to 50K, right? And I'm very comfortable doing that. I've been doing that with companies out of YC, whatever. If I was doing Series A investments, it's very difficult because I'm writing a bigger check, several $1 million. To do that without meeting a person, getting to know the person, is very difficult for most investors, including myself.
Yeah.
So what would happen is, because with social distancing, there still are opportunities to actually meet people with masks on, whatnot. You will try to meet people, and some people do it early on. Other people actually, because that's a high risk, will save that until the very end. And that becomes kind of the final kind of due diligence step before they decide to write a check or not. So they've done their market research, competitive analysis, financial analysis, and I want to actually, take a walk which you can do socially distance, for an hour in Palo Alto, and you get to know the other person, see if it's somebody that you really want to work with, somebody you can trust, and vice versa, before you actually agree to move forward with the financing. So that's what's happening in the US. I feel that in Korea, it's almost business as usual.
It is pretty much business as usual, and obviously in-person meetings are happening. There have been a few times this year where things have clamped down a bit, but it's back to normal pretty much. Okay, so it sounds like COVID hasn't really changed the process that much, in that in-person personal relationships and in-person meetings are still important. It's just
And again, it's not important for every stage or every investor,
right.
but typically if it's more capital that goes in, it's de-risking to a certain extent by spending time with the individual and getting to know them. And again, it's almost like a habit. I don't think you necessarily learn more than doing a Zoom call like we are.
Mm-hmm.
But there is a stigma to, oh, I've actually met the person, I feel comfortable with this person. And to be able to tell your investment committee partners that, hey, I've spent a couple of hours over dinner walking with this partner, and I think he's a good guy, I think I can trust him, and I can work with him. It's just one of the many due diligence checklist items.
Yeah, it certainly makes sense. Yeah. And I guess on that front, we'll hope that things do turn back to normal in the US before too long as well.
Yeah, it's going to be a while in the US.
Yeah. So I think we've pretty much come to the end of the questions and our time. I have been monitoring the chat, and there haven't been too many questions here. So hopefully that means that we've covered everyone's questions anyway.
That is very disappointing, but that's fine.
One quick thing. So in terms of next steps, now obviously you're not going to be the right investor for every company, and you've stated quite clearly the things that you are interested in terms of a kind of industry and stage. Is it okay for any of our companies to reach out to you, and if so, what is the best way of doing it without wasting your time or theirs?
Yeah, so I would welcome companies to reach out to me, and again, with the caveat that in terms of stage, in terms of sector of interest, you're looking for a fit, right? And there's plenty of great investors out there that may be a better fit for what you're doing.
Yeah.
Let me be clear, Nathan, in terms of what I'm looking for. So I actually have two hats, right? So my day job, advising Deutsche Telekom Capital Partners, growth stage, B2B SaaS. I don't think there's too many early stage companies that would apply for that. So let's put that aside.
Yeah.
From an early stage perspective, I've actually done a fair amount of angel investing in Korean entrepreneurs over the years. I was an advisor and early investor in Noom, in Coupang, in Corbit on the blockchain side, and a handful of others, some gaming companies and whatnot. So I actually enjoy that engagement. So I think the best way to do it is if you have a business plan that you want to send over to me, maybe through you, Nathan.
Sure.
What I can do is I can definitely spend the time to read through an executive summary or a deck.
Mm-hmm.
And if it's something that's interesting to me, then I would be more than happy to connect. And there could be a personal relationship. I've done angel investing, as I said, and that's something that I enjoy doing. It's kind of like a hobby for me.
Yeah. Okay. Good to hear. And we do have executive summaries. So, for any companies on this call, if you are interested in connecting with Jay, let me or Peter know, and we can help you connect.
I noticed there's one question here. Let me just address this question. I think it's important.
Sure. Yeah.
So again, if you would like to raise your Series B from the US, would you recommend switching your headquarters to the US? So my quick answer to that is, switching your headquarters is not something that you should do to raise your Series B. The question is, why do you want to raise your Series B from US investors? Is there a business reason that you want to raise your Series B? Because if your business is not in the US, why would you want to raise capital from a US investor? You know, it has to make sense. And again, depending on the stage of business, I mean, raising a Series B, if you're at that revenue run rate, okay, so great. So if your main market is in the US, then absolutely you should be in the US, right? But before you can raise, again, fundraising is the last thing to worry about. If you believe that having your headquarters in the US will help you build your business in the US, you should absolutely do that, right? Now, the question is, do you have the capabilities on your team and yourself as an entrepreneur to run a business in the US? You know, can you speak English? Have you been educated in the US? Do you have a relatively, strong business network out there? If you do, fantastic, great. You can be the next Senberg. If you don't, then you should consider adding people on your team that actually can help you do that. What you don't want to do is to be the fresh off the boat, entrepreneur. And I've seen too many of them. And Nathan, you know who I'm talking about, that are guts only. 주먹 쥐고 될 때까지 안 들어가겠습니다. 꼭 성공하겠습니다. Without any experience, any contact, can't speak the language, no business experience. It's not going to work. Those folks try for a couple of months and they go back home. And what I really, really am disappointed about is those companies I've monitored and tracked because I've built relationships. They go back to Korea. They built a successful business in Korea. And even though now I believe they have the resources and capability to go overseas, they're scared to do it. Oh, last time we did it, we wasted so much time and money. I don't want to do it again. That is the saddest thing, right? So Nathan, you know this well, and I talk about this all the time. The most important thing is the timing. And the timing is dictated by both the external opportunity, but also your internal capabilities as well. Anyway, so I'll stop there.
Thanks
so hopefully that answered your question.
Great. Well, I think we are out of time. So thank you very much, Jay. It's been very interesting talking to you as always. Really hope this has been valuable for the companies on the call as well. We've got a recording of this entire conversation, so I'll share it with everyone. And if you want to be connected with Jay, drop me or Peter an email, and we'll do what we can to help you connect. And
sounds great. Yeah, enjoyed it, Nathan, as always. And again, feel free to reach out if I can be helpful, guys. Again, I may not be able to get too hands-on with every single company, but I typically will be responsive. So let me know, and at least I'll get back to you. Okay?
Great. Thank you very much, Jay. Have a good evening, a good family dinner.
All right. Good luck to everybody. And thanks again, Nathan, for the opportunity.
No problem
at all. Thank you, Peter, for arranging this. Appreciate it.
Great. Thank you very much for your time, Jay.
Okay. All right. Take care, gentlemen. Bye.
Thanks.
Bye-bye.
Bye.
Thank you.